Hi guys, welcome back to our YouTube channel SimpliFlow. In this video, we are actually going to see about golden rules of accounting concepts and convention. First, let's see about the golden rules of accounting. There are three types of accounts, that is personal account, real account and nominal account. We are going to see the golden rule under each type of these accounts. As for personal account, the golden rule is debit the receiver, credit the giver. Let's understand this with an example. Here, if we pay salary to Ravi, so a company is actually paying a salary to Ravi. So here Ravi is receiving the money. Actually, the golden rule is debit the receiver, credit the giver. So who is receiving the money here? Ravi. So we should debit Ravi's account. So Ravi account debtor. Who is the giver? What's going out? Cash is actually giver. Cash, we are giving those salary as a cash. So it's a giver. We should credit that cash. So Ravi account debtor to cash account. This is the golden rule for personal account. And as for the real account, the golden rule is debit what comes in, credit what goes out. Let's go with an example. If furniture is purchased for cash, so we are actually purchasing the furniture for cash. So actually what comes in? Here furniture is coming in. So debit what comes in. So the furniture is coming in. We should put the entry as furniture account debtor. And credit what goes out. Here what we are giving and purchasing the furniture. We are just giving the cash out and we are getting the furniture in. So to cash account. Furniture account debtor, debit what comes in. To cash account, credit what goes out. And the third type is nominal account. And the golden rule for nominal account is debit all expenses and losses, credit all income and gains. The example is salary paid, rupees 5,000. So we all know salary is an expenses because the company is going to pay the salary to an employee, which is an expenses. So here what they had said is debit all expenses and losses. So what we should do is, it's an expenses, we should debit it. Salary account debtor, we will pay the salary as cash only, no. So to cash account. Let's see another example for income. Let's see as rent received. So rent received, we are actually receiving as a company, we are actually receiving the rent. Okay. So it's an income for us. So how the entry will be is cash account debtor to rent received because it's an income. What they are told here under the golden rule, credit all income and gain. So cash account debtor to rent received. So these are the golden rules of accounting. So I hope this is clear and this is the very easiest topic to understand. Simply we should remember it as personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all income and gains. This was all about the golden rules of accounting. Now let's move on to our next topic, that is gap. Gap. What do you mean by gap? What is the full form for gap? So let's see. Actually, the full form for gap is generally accepted accounting principle. Actually, this gap was subdivided into accounting concepts and accounting conventions. So this combination of accounting concepts and convention is known as the gap, that is generally accepted accounting principle. Let's see in detail about accounting concepts and accounting convention. First, let's see about the accounting concepts. Actually, accounting concepts are the basic assumption, principles, rules and guidelines which should be followed by the company. If a particular company is choosing any one of the following concept means, they have to adhere to the rules and guidelines which was given under that particular concept. That is known as the accounting concept. There is there is no relaxation for them. They have to strictly adhere to those rules and guidelines. That is known as the accounting concept. The first concept is that business entity concept. That is the owners and the business are two different parts. They are totally different. If a business is run by me, okay, so the business is separate and as a owner I was separate. If I have any personal expenses, I have to take it from my own only. I should not touch those amount in my company's account. Okay, those expenses as my company's account. I should. That's why they always call it as, I mean, under business and entity concept, they call it as business and owner or completely separated. They are also given an example. If I was investing rupees 1 lakh in a business, it's a capital introduced. It should be in the business only. I was in an urgent need of rupees 1 lakh, means I should not withdraw that money from the business. Business should be separate and my personal life should be separate. Personal expenses should be separate. That is known as the business entity concept. And the second accounting concept is going concern concept. That is, whatever comes in, whatever goes out, the business will keep on running. Even if I am entering into the business, I was retiring from that business, so I was leaving the business in the halfway. The business don't care. It will keep on running. Whatever the persons comes in or goes out, it won't bother about it. It will just keep on running for a long period. And the focus is on the future growth only. That is known as the going concern concept. And the third accounting concept is that money measurement concept. It's simple. We already seen in accounting, no? So that is, it will measure only those things which can be measured in money terms. Purchase of goods worth of rupees 10,000, it can be recorded. But the employees' honesty, loyalty, good personality, these qualitative nature cannot be recorded. This concept is known as money measurement concept. And the next concept is cost concept. Cost concept means historical cost concept, simply we can say. That is, if I was purchasing furniture worth of rupees 5 lakhs in 2010, means after 2020 also I will record that furniture as 5 lakhs only. I won't change the value. How many years it goes on, the worth of that furniture is 5 lakhs. They won't consider an market value. They will just always consider the purchase price of that particular asset. It is known as the cost concept. And the last accounting concept is dual aspect concept. So it actually has two sides. Simply we can say debit and credit. Debit, that is a Ravi account data to cash account. It is a double entry system. We will just record it in 2 times. That is dual aspect concept. We can just say it as journal entries. We record debit, both debit as well as credit. No, it's the dual aspect concept. So now let's move on to the next section of gap, that is accounting conventions. Accounting conventions are completely opposite to accounting concept. We seen that accounting concepts are the rules and guidelines which should be followed by each and every company, which was given by GAP, generally accepted accounting principle. But here in accounting conventions, they have actually they don't have any such kind of rules and guidelines they have to follow. They are just free to change their rules anytime. That is known as the accounting conventions. There are 4 conventions. The first convention is convention of conservatism. That is, the accountant and the company will focus only on the losses. They don't bother about the profit. Whatever profit they earn, they don't bother. They will just focus on the losses and they will think about how to overcome those losses. That is known as the convention of conservatism. And then second convention is convention of full disclosure. They will just prepare a accounting statement and disclose all the information to the public, to all the members, all the shareholders. All the information, even a small information will be shown, disclosure to the public. That is known as the convention of full disclosure. Then third convention is convention of consistency. Even so many years has been passed, I will just use the same accounting method. Last year, what accounting method I have used, the same accounting method will be used this year. So many, after 10 years, after 20 years, whatever happens, how many years have been changed, I will just use the same accounting method. They won't just change any kind of method. They won't change to any other methods. Why they are always consistent in this method means because it helps to compare between 2 years. That's why they are actually using the same method for so many years. So next, that is the last convention, is convention of materiality. So it's actually quite similar to convention of full disclosure. In convention of full disclosure, we had seen that all the information will be disclosed to the members or shareholders or public of the company. Likewise, in convention of materiality, only important information, material information will be disclosed to them. Whatever the information it is needed for the public, the shareholders, it will be only shown in those statements. They won't disclose any information which is related to the internal management. That is known as the convention of materiality. Only the important information will be disclosed. So these are the different accounting conventions. So I hope in this video we have seen about golden rules of accounting and GAAP. GAAP is nothing but the accounting concepts and conventions. So from next video onwards, we will just focus on separate subjects. In this separate subject, we will focus on separate topic, not only the theory but also the problems which was given in our books. We will see each topic under this topic, both theory as well as the problems under each subject. The subjects are mentioned in as next videos. So if you like this video and find useful, do like, share and subscribe. Thank you guys. See you soon in next video.